Let's compare two different formats of the income statement. We have been looking at the absorption costing income statement all the way through the financial accounting portion of the course, right? So the traditional format of the income statement, when you're in a managerial context, you would call it the absorption costing format, and it's because we're looking at cost of goods sold and we are absorbing the variable costs and the fixed costs. We're concerned more about the category of the cost and not whether it's variable or fixed. When we get to the contribution margin format, which is more helpful in the managerial setting, then the emphasis isn't so much on is it operating cost, is it cost of goods sold or cost of goods manufactured. The emphasis is exclusively on is a cost variable or is it fixed. So let's just look at a bit of comparison. So the traditional or absorption costing format, sales minus cost of goods sold gives us gross profit, less operating expenses gives us net income. In the contribution margin format, same sales number, less now variable costs. All of the variable costs. Doesn't matter what their category is, whether they're part of cost of goods sold or operating expensive. If it's variable, it's placed above so that we can then determine contribution margin. Then we subtract the fixed costs and we get the same net income number. So it is a different breaking out of the expenses, but the top line sales and the bottom line net income are going to be exactly the same. So let's look at this with a numerical example just to sort of highlight the differences. Let's say we have sales of $80,000. It was 800 units at $100 each. Less cost of goods sold of $60,000. That would give us gross profit of $20,000. That $60,000 of cost of goods sold, some of those costs are fixed, related to the rent or perhaps straight line depreciation on some of the factory equipment or salaries for the factory supervisor. So some of the cost of goods sold is fixed cost, $20,000, and part of the cost of goods sold amount is $40,000 of variable costs. But it's all part of cost of goods sold, and in the traditional format, it's up top. And so we have gross profit of $20,000, subtract out the operating expenses of $4,000, and in this case, half of them are fixed cost, half of it's variable cost, and you end up with net income of $16,000. Well, let's look at how this information would be organized in the contribution margin format of the income statement. So we'd still have the same $80,000 of sales, right? 100 units at $80 a piece, and so $80,000. Then we would subtract all of the variable costs, and we would come up with contribution margin. And those variable costs are both categories, the $40,000 that came from cost of goods sold and the $2,000 that came from the operating expenses. But the order is that we subtract out the variable costs first to come up with the contribution margin, and so both categories of variable costs are up top. So we're at contribution margin of $38,000. And then we're going to subtract the fixed costs. And again, that's $20,000 that was related to the cost of goods sold on the previous slide, plus $2,000 related to the operating expenses from the previous slide. And we end up with net income of $16,000. So there are two different ways to go from sales to net income. One is through the absorption format income statement that you see more in financial accounting, and the other is the contribution margin format income statement that we'll use very heavily in the managerial portion of the course.